Welcome to Wealthfinity, where we empower individuals to take control of their finances and achieve financial freedom. One of the most common financial decisions people make is taking out student loans to pay for their education. However, the world of student loans can be complex and confusing, particularly when it comes to understanding the differences between subsidized and unsubsidized loans. In this video, we will help you master the differences between subsidized and unsubsidized loans, so that you can make an informed decision when it comes to financing your education. Whether you are a student, parent, or just interested in learning more about student loans, this video is for you. So, let's get started and take the first step towards mastering the world of student loans. Taking out a loan can be a smart way to achieve your financial goals, whether it's buying a car, starting a business, or funding your education. When deciding to take out a loan, it's important to evaluate the interest rates, terms, and benefits of subsidized and unsubsidized loans to make an informed decision. This video will provide an overview of the differences between subsidized and unsubsidized loans, how interest rates and terms affect the total cost of a loan, and the benefits of each type of loan. Subsidized and unsubsidized loans. First, let's define the two types of loans. Subsidized loans are available to undergraduate students who demonstrate financial need, while unsubsidized loans are available to both undergraduate and graduate students regardless of financial need. The key difference between the two is that the government pays the interest on subsidized loans while the borrower is still in school, while the borrower is responsible for paying the interest on unsubsidized loans. Interest rates. Interest rates are a critical factor to consider when taking out a loan. The interest rate is the percentage that the lender charges the borrower for the use of their money. Typically, subsidized loans have lower interest rates than unsubsidized loans because the government pays the interest on subsidized loans while the borrower is still in school. However, it's essential to note that interest rates are subject to change and can be influenced by a variety of factors, such as the borrower's credit score, the length of the loan term, and current market conditions. Terms. Loan terms refer to the length of time that the borrower has to repay the loan. The term of a loan affects the total amount of interest paid over the life of the loan. Typically, the longer the loan term, the more interest the borrower will pay. For example, a 10-year loan term will have a higher total interest cost than a 5-year loan term. Therefore, it's important to choose a loan term that is manageable for your financial situation. Benefits. The benefits of subsidized and unsubsidized loans differ. Subsidized loans have the advantage of lower interest rates and the government pays the interest while the borrower is still in school. On the other hand, unsubsidized loans can be borrowed by students who do not demonstrate financial need and can be used for a broader range of expenses, such as living expenses, transportation costs, and other education-related expenses. When evaluating interest rates, terms, and benefits of subsidized and unsubsidized loans, it's important to consider your financial situation and long-term goals. A lower interest rate can save you money over the life of the loan, and a shorter loan term can help you pay off the loan more quickly. However, it's essential to balance the benefits with the repayment terms to ensure that the loan is manageable for your financial situation. By evaluating these factors, you can make an informed decision when taking out a loan that will set you up for financial success in the future. Interest rates, terms, and benefits of unsubsidized and subsidized loans. In addition to the differences in interest rates and terms, there are several other benefits to consider when evaluating subsidized and unsubsidized loans. Here are some key factors to keep in mind. 1. Repayment options. Both subsidized and unsubsidized loans offer a variety of repayment options. Federal student loans typically offer flexible repayment plans, including income-driven repayment plans that base the monthly payment on the borrower's income and family size. Private student loans, on the other hand, may offer fewer repayment options and can be less flexible in terms of payment terms. 2. Eligibility. Subsidized loans are only available to undergraduate students who demonstrate financial need, while unsubsidized loans can be borrowed by undergraduate and graduate students regardless of need. This means that graduate students may only be eligible for unsubsidized loans, which typically have higher interest rates than subsidized loans. 3. Interest capitalization. Another important factor to consider is how interest is capitalized on the loan. Capitalization refers to the process of adding unpaid interest to the principal balance of the loan, which can increase the total amount of interest paid over the life of the loan. Subsidized loans do not accrue interest while the borrower is in school, which means that there is no interest capitalization during this time. Unsubsidized loans, on the other hand, accrue interest while the borrower is in school, which can result in higher interest costs over the life of the loan. 4. Loan limits. The maximum amount of subsidized and unsubsidized loans that a borrower can take out depends on a variety of factors, including the borrower's year in school and the cost of attendance at their school. Typically, subsidized loans have lower annual loan limits than unsubsidized loans, which means that borrowers may need to take out a combination of both types of loans to cover their educational expenses. When evaluating interest rates, terms, and benefits of subsidized and unsubsidized loans, it's important to consider all of the factors that will impact the total cost of the loan. These factors include the interest rate, loan term, repayment options, eligibility, interest capitalization, and loan limits. By understanding these factors and carefully weighing the benefits and drawbacks of each type of loan, borrowers can make an informed decision about the best way to finance their education or other financial goals. In conclusion, understanding the difference between subsidized and unsubsidized loans is crucial for any student or borrower seeking financial aid. Subsidized loans are typically the better option, as they do not accrue interest while the borrower is in school and during certain periods of deferment, making them more affordable in the long run. However, not everyone may qualify for subsidized loans, in which case unsubsidized loans can still be a valuable resource for covering the cost of education. Remember, taking out loans is a serious commitment, and it's essential to approach this process with caution and careful consideration.